We also have Lata joining us in the studio. Lata, after CPI, even the WPI number lower than estimates.
Yeah, you know, the primary articles inflation has come down, so sharply. It was kind of already available to us as a trailer when the CPI came. Remember, the CPI was singly brought down by vegetables. Now, vegetables would come in the primary articles category, and therefore I'm not surprised. We have to look at how manufacturing inflation has fared. If that falls, we would be better off.
It's fallen as well. Manufactured products inflation is 3.6%. This compares with 4.4% month on month. So month on month, there has been almost an 80 basis points decline in that one.
No, that would be important because all these things would go into the core inflation sooner or later. And if these fall, then you can see if wholesale prices of manufactured goods start falling, sooner or later they will start coming on into the retail inflation as well. So we have to keep a sharp eye out on that. I'm still waiting for more details on the internals. Okay, I think we now have the food index come up specifically, down 1.8% on the month. I mean, that's huge. And my sense is that it would be tomatoes and other vegetables. Tomatoes were particularly important in the CPI, and it's quite possible that that is, responsible in this case as well. There you have onion inflation minus 19.2%. So it already fell in the previous month, and it has fallen further in the month of November. So that is contributing in a big way to the primary articles inflation coming down. Food and primary articles form a smaller part of WPI. The bigger part is manufactured goods.
The entire vegetable index itself is down almost 16.8%, 17% on the month. So, of course, you spoke about, tomatoes and onions, etc. Potatoes as well, down from 44% to close to around mid-teens, etc. So all of that means that things are perhaps on the mend?
No, the food is definitely on the mend. The worry always was with core inflation. The non-vegetable items in the CPI did not fall as much. Cereals and milk were actually higher month on month. So it was largely vegetable driven, and even over here, as we can see, a month on month 16.8% fall in vegetable index indicates that it is having an outsized impact on WPI as well at this point in time. It should come over to other commodities. Now you look at the all commodities index, it is down 0.3% month, whereas vegetables is down 16.8. So you can see that it has had a slightly outsized impact. But manufactured goods also see basic metals index down 1.6 on the month. The fuel and power group index is, that is the one that's up. Manufactured goods more generally is down 0.3% on the month, and therefore those would be positives. But let's leave it to the expert. Rupa Regeretsuri, the chief economist at L&T Finance, joins us. Rupa, from the numbers you have heard, is this positive? Do you think that we can see WPI having a more benign impact on CPI in the coming month?
Certainly, but I don't look at it entirely from that perspective. After all, it's a producer price index, and it shows, the manufactured product price inflation also is an indicator of manufacturing companies' pricing power. And, as RBI policy statement also had said that there is a lot of pent-up, lagged price increases, etc. They are still trying to pass it on. But the fact that WPI manufactured product index is down 0.3% on month, I think that also shows growing weakness in demand.
Oh, yes.
And so despite the fact that they still have the burden of elevated costs from past months, but they are not able to increase prices because of weakness in demand. And this is consistent with all other statistics.
Yeah, the IIP number coming in as a contraction, I guess you're referring to that.
GDP, exports, then your corporate earning results, because there is a shrinkage of
so it's not all good. We are also having to worry that manufactured products or makers of manufactured products are not able to pass on their price increases. There is another number I want to comment on. It says core inflation is down at 3.5 compared to 4.5 in the previous month. Should that be read positively?
It should be read positively in the sense that clearly means that there is a loss of pricing power and cost cost pressures are not being passed on. There is no indication of overheating from the demand side. So I think this number carries a lot of weight from that perspective for the next policy statement.
Okay, you would expect, therefore, the governor could hold off. It could be a pause.
I will not rule out that possibility.
All right, don't rule out the possibility.
The pace at which things are deteriorating,
Yes.
he will certainly observe very minutely the now growth trends from other sources also.
Oh, yes, growth. That's the danger mark. Thank you very much, Rupa, for giving us that spin on the WPI numbers. I think these are important observations she's making. The fact that the wholesale price guys are not able to pass on their price increases is an indication of probably weak demand. The IIP already gave us a trailer of weak demand or weak output in manufacturing. And all this will prey on the MPC's mind when they sit to make their judgment in February. If growth is a bit weak, maybe they may want to pause as early as February. Though, the Reserve Bank's overall language in the previous policy was a little hawkish. Overall, this is positive for bonds. So let's just bring up the bond market indexes and see whether it's had any benign impact on bond prices itself. If the yields have gone down, I think that'll come up for you in just a bit, the 10-year bond index. The 10-year bond indexes the yields did fall by about 2 or 3 basis points when the CPI numbers came in. But we will have to wait and see whether there is any impact now.
I'd love to know from Rupa. Rupa, today there is the US Fed meeting. Of course, they are expected to hike rates by about 50 basis points. How much of yesterday's inflation data will have a bearing on their commentary? What do you think that happens? And in light of what's taking place globally, how much of the current numbers, domestic numbers, matter from an RBI policy standpoint?
Yeah, that's a very good question. I think the way things are panning out, not just in India, but in other emerging markets as well as other advanced countries also, central banks now will start giving more importance to their domestic growth inflation dynamics than just taking cues from what US does. We had seen that last time also, the way Bank of Canada reacted after US Fed increased its policy rate by 75 bips. Because you see, recessionary tendencies are growing everywhere.
Yeah.
And in all these, even in India, our inflation targeting is flexible inflation targeting. It's not fixed inflation targeting. So growth considerations are not entirely ruled out.
Okay.
So, and as I told Lata, our, various multiple data sources now are pointing to weaknesses in manufacturing sector, demand, overall demand, which is a main employment generating sector.
Yeah.
So naturally, Reserve Bank of India and MPC members will take into account all these incremental data points before, going for aggressive tightening or doing overshooting of tightening.
All right. We'll leave it at that. Rupa, thank you very much indeed for joining us. So the CPI brought the Indian yields from about 7.3 to 7.27. And today they have gone down from 7.25 to 7.23, or actually 7.26 to 7.23. There's been a 3 basis point fall.
Okay.
Just as Rupa says, there is now a small corner which believes that the RBI could pause as early as February, though their December 7th statement clearly indicated they are not done with removal of accommodation. As they said, the worst of inflation is behind us, but the job is not done. That clearly was there. So it anyway becomes open, and there are so many events. You have the US Fed, and then you have one more inflation print, both in the US and then there are non-farm payroll numbers. So I guess it's still very open till the first week of February. Okay. At the moment, we can only say it's a little positive in terms of the RBI's not having to push too much.